I would say we start, and later on we can keep on letting people in. First of all, everyone, thank you so much for joining us tonight. Hello, everyone. My name is Gabriela Sanchez. I'm Chief Operating Officer at Galileo Impact Investing Center from SUC, and I am very happy to welcome everyone tonight at this session. A couple of words about Galileo. First, we are a nonprofit tax-exempt association based in SUC, and we follow the mission to promote impact investing internationally and to provide accessible education for everyone, especially in the area of impact investing. In the name of the team and of the founders and supporters, I welcome you all today to our webinar, Stock Market Investing in an Era of Climate Change. And we are very honored to welcome James Ellman and Ben Banerjee tonight, who are connecting. James is connecting from California and Ben from Zug, Switzerland. James has more than 2 decades of experience as a professional investor, and he has led various teams at financial institutions such as Invesco, Merrill Lynch, Seacliff Capital, and Ascent Capital. Ben, on his side, is a serial entrepreneur, international impact expert, and expert as well in climate change. He is president and co-founder of the Swiss Impact Investment Association, also based in Zug, Switzerland, and member of the Climate Leadership Coalition. Ben is kindly joining us today to help us moderate and support the discussion with James Ellman, who is going to provide us with more insights about his new book that he just released last July, Hot Stocks, Investing for Impact and Profit in a Warming World. Thank you both for joining us. I would like to, before we start, briefly show you also a little bit about the work that we are doing also in the upcoming time. In November, we will be meeting again, same channel, stay tuned, and the same time also at 19-hour CET. And we will go with James Ellman into a deep dive into the energy sector transformation in this era that we are all living of the climate change. So at the end of the webinar, you will get more information about how you can register for this next webinar, and just a couple of organizational, let's say, suggestions. Let's keep our audios and our videos on off during the conversation. If you have any questions, please feel free to drop them anytime into the chat box. And at the end, in the Q&A session, then we will answer all the questions that have not been yet discussed during the event or during the main part of the session. Said that, I would like to leave you guys with James and Bern. And again, thank you so much for supporting Galileo on the mission of promoting impact investing for everyone. Thank you both. I'll let you, James, take over with the slides.
Very good. Gabriela, Ben, thanks so much for having me today. Let me just start the presentation.
Yes. And I'll have a look if there, oh yes, I need to get some people in, so you can start. Thank you.
All right, so good morning, good afternoon, good evening, wherever you are tuning in from. Let me just go over what we're going to discuss today, hopefully for about the next hour. I'm going to be focusing my comments in terms of impact investing on how one can invest for green energy and mitigation and adaptation for climate change, not only to mitigate climate change, hopefully allow the human race to adapt to it. And I believe that investing in this area will increasingly become a better way to invest and generate outperformance in the markets going forward. So we're going to discuss how impact investing is going to become more important, why that portfolio that is going to be focused on alternative energy and green investing is going to outperform, a framework to decide how quickly to move forward as you decide to migrate your portfolio to an impact investing portfolio, and then focus on some of the specific sectors and companies that should outperform in a world as the climate is changing. So first of all, again, how is impact investing becoming more important? Well,
and James, I'll be jumping in once in a while. Maybe it makes sense if you can also say, how do you differentiate between sustainable and impact investing?
Right, so in terms of the concept of impact investing would be to be investing to create a positive change in the world. There are several different positive changes in terms of the ESG umbrella that people are working with today. However, my focus is on environmental investing, and sustainable investing would be investing in those companies that are going to be reducing greenhouse gas emissions into the atmosphere and slow the rise of the temperature in the world, which leads to a whole host of negative cascades, such as rising temperatures, worsening storms, more violence among humans, rising sea levels, acidification of the oceans, changes in precipitation, basically, unfortunately, a real negative impact across our entire civilization as a human race.
Exactly. And what I would like to add is that in impact investment, what we can also sometimes look at is we look at the 17 SDGs of the United Nations as a kind of theme. So each of these SDG, for example, life on the water, climate change. So each of these SDGs we can look into it as a kind of impact investment title or theme. At least that's what I do.
Very good. So if we can just start to go through how consumers are starting to pressure companies to change what they're doing. If we have a few examples here, IKEA, the world's largest furniture seller, selling products which have been taken some heat from consumers for selling a disposable culture, creates too much waste. IKEA has changed its business practices by changing all their shipping pallets to recyclable material, only selling LED light bulbs in their stores, and installing a huge number of solar panels on top of their buildings. Kimberly-Clark, another business that at first sounds like a very much a company that's part of the problem, in that they sell toilet paper, Kleenex, disposable diapers, lots of products that end up in landfills have to be created out of trees and utilize a lot of energy to produce. Kimberly-Clark was under a lot of pressure for many years from Greenpeace and other nonprofit organizations. Kimberly-Clark sat down with Greenpeace and has put together a plan where they are reducing their carbon emissions. They're sourcing their products solely from sustainable forestry at this point. They have significantly reduced the amount of product that they send to landfills. British Petroleum, now BP, of course, was a large, one of the big seven sister oil companies. As you can see, they changed their name to take petroleum out of it. It's just BP now. They changed their logo to a very friendly looking green and yellow starburst. And if you just look at that amount, of course, that sounds like some potentially greenwashing, but they really have made significant changes. And just recently, they changed the title of what their business is from being an IOC, an international oil company, to an IEC, an integrated energy company. And they have announced they're not going to be drilling in the Arctic anymore. They're not going to start drilling or looking for oil in any new countries. They've been investing in electric car charging stations, wind turbine farms, and to a certain extent, they've also been shifting their production from petroleum, which is more carbon intensive, to natural gas, which is less carbon intensive. Companies, just to give you a couple of other examples, that have really been changing their business practices. HSBC just last year announced that they would no longer fund coal-fired burning power plants almost anywhere in the world. They announced they would not finance tar sands mining and synthetic oil production from those tar sands. They would no longer finance new projects to drill for oil in Arctic areas. Many financial services companies have been following along or had gotten there before HSBC. Some companies such as AXA and many other insurance companies will no longer insure the operation of coal-fired plants, will no longer insure Arctic drilling. And many of these financial companies, which of course control very large amounts of capital and bonds, have begun to divest from the oil and gas industry. Royal Dutch Shell, similar to BP, has been changing its business practices, shifting away from oil towards natural gas. In fact, their C-suite executives have traded in their internal combustion engine cars and now drive hybrids. And their board has actually changed the compensation scheme where the C-suite executives now are partially compensated by how much they can reduce the carbon intensity of Shell's output each year. One last example, just to discuss how these business changes are taking place at even a smaller company level. New Belgium Brewing is a beer company that whose products I enjoy here in the United States. Their lead product is Fat Tire Ale. Fat Tire Ale is now the first carbon neutral beer on the market here in the United States. That costs them some money, but they are hoping that that is going to lead to higher sales for them. So we're seeing significant changes in business practice across many sorts of industries.
But James, aren't you worried that some of these companies are also maybe trying to greenwash? For example, the French oil giant company, oil company Total, claims to be also a climate leader on this field. On the other hand, they are creating or building now a heated oil pipeline through the heart of Africa, which will go through, I thought, like 12 protected forests and 200 rivers. So just God forbid if there is an oil leak. So isn't it a bit scary to give a kind of carte blanche to these multinationals whose prime motivation sometimes is just pure profit?
Well, if I could address Total specifically, and then this next slide here on how investors are demanding change, and hopefully that will tie in together. First of all, Total just announced earnings recently, and they wrote down several $1 billion worth of their oil assets and declared that they are stranded assets, meaning they do not believe they will ever be able to pump much of these hydrocarbons out of the ground. They also had a multi-billion-dollar investment in Canadian tar sands, the most carbon-intense petroleum products or hydrocarbon products in the world today. They wrote off their entire investment in tar sands, and they withdrew from the Canadian Petroleum Association, saying that their mindset towards a world of zero carbon emissions does not mesh with that of the Canadian Petroleum Association. So they simply withdrew and are no longer part of the organization. So while Total certainly has a long way to go and may not be at the forefront of energy companies and hydrocarbon companies as they shift their business models, they certainly did take a good step forward. And then if I could comment on what investors are doing at the institutional level, and this is also taking place at the retail level and high net worth level, but a large number of institutions don't accept what Total or BP or Shell are doing is enough, and they're simply divesting from the hydrocarbon space. So the Fossil Free organization now has almost $15 trillion of assets under management that has said they will simply not own anything in the hydrocarbon space. Potentially, or hopefully even more impactful, is the Climate Action 100 Plus. It started with 100 members, now it has many more. It's up to about $40 trillion in assets under management. And Climate Action 100 Plus has a large set of target companies which they meet with. They're primarily in the hydrocarbon space and the mining space. And they demand, as their larger investors, that those companies start to measure their carbon intensity, start to measure their emissions, and come up with a plan to reduce those emissions over time and their carbon intensity over time. Climate Action 100 Plus, they were one of the organizations that were able to lean on Total and get Total to write off its tar sands operation, lean on Shell and get Shell to, or let Shell to change their compensation standards so that the C-suite is now partially compensated on a reduction in carbon intensity. And so one would hope that over time, I'm not saying that all the hydrocarbon companies are perfect, but we do at this point still need some hydrocarbons to run our society and our civilization. And we can hope that with some luck, they will become partners with the rest of humanity in reducing carbon emissions rather than a company financing industries and politicians that support business as usual.
Yeah, I just wanted to add to this, James, in some cases it's a bit not that positive. For example, what you mentioned is true because in the Climate Action 100 Plus, there is a very strong initiative, motivation, fossil fuel development also. On the other hand, you still see countries like China, US, Russia, which are still proceeding very fast with extraction of fossil fuel, especially now with the global warming, the Arctic is coming more and more free. That to me sounds a bit scary. Also, Germany is, it speaks more than it is acting on that way. And if you look at the major institutional investors who are investing into large corporations, and they have been doing it since a long, long time, especially the central banks and major banks, are still going on doing it because they think this is the stable investments. They're still investing heavily into major corporations, while these corporations are based on fossil fuel. So I was recently, not recently, a couple of years ago, I was in a study where they found out that if we go on with the investment strategy that at this moment institutional investors are following, we are not heading for a 2-degree rise of temperature. We are heading for 4 to 6 degrees rise of temperature. And to make a situation even worse with the COVID, what we have a kind of side effect is that the EU had put aside quite a big amount of money to invest in climate change related projects and to fulfill EU's commitment to the Paris Agreement. Now, a big chunk of that money has been taken out from there and is being invested to protect economies which have been devastated by COVID. So in that aspect also, EU has lost quite a considerable amount of investments which were meant for climate change. I just wanted to add to this thing that you have on one side, you have the movement which you are mentioning, but on the other hand, sometimes the facts and the figures are not catching up.
I couldn't agree more. This is a crisis of our civilization, one where we need to move quickly now. And if the faster we move now and the better the technology we can come up with now to more quickly end the age of oil and also come up with technology to sequester and store carbon and remove it from the atmosphere is dearly important to our progeny and the people who come after us. And one thing we can do as investors is, again, to either divest completely from fossil fuel companies and invest in alternative energy companies, which of course will drive up the cost of capital of hydrocarbon companies and drive down the cost of capital for the newer technologies, and will also drive the managements of many of these companies to act. We will not be able to get every management of every company in the hydrocarbon space on board, but hopefully we can move towards a world in the next few years with our own actions by changing how we invest our own dollars, our own euros, our own francs to create difference in the capital markets. Just to take a look at that for a minute, I mean, clearly in the alternative energy space and green technology companies, they are really starting to outperform. I have just a few examples here. The URTH, that's the MSCI World Index, and you can see how well Tesla, who everyone knows about, has outperformed. Sunrun, a company that installs solar panels on individual homeowners' roofs in the United States. And Plug Power is a company that makes hydrogen fuel cells primarily for forklift and trucks and buses increasingly around the world. So this used to be a business investing in alternative energy and alternative transportation that was simply a way to lose money in a noble cause. Increasingly, it's a way to outperform. And if we take a look at what's been happening in the hydrocarbon space, take a look at what's happening in the most carbon intensive hydrocarbon companies. Again, the URTH, the orange line, that again is the MSCI World Index. And you can see these three very carbon intense hydrocarbon companies significantly underperforming. SU is Suncor in Canada, which is heavily engaged in tar sands development. MRO, that's Marathon Oil, and you can see BP as well. Yes, the market is down today, Tesla's down, but so certainly are all of these oil companies. And we've increasingly been seeing, even with falling oil prices, which you would think would be a negative to companies like a Tesla or a Plug Power or a Sunrun, because the cost of electricity and the cost of petroleum are going down that are generated from hydrocarbons, so the electricity from hydrocarbons. That has not been the case. The cost of capital for alternative energy companies has been going down. The cost of capital for hydrocarbon companies have been rising. And so that, again, is why I believe an impact portfolio oriented towards climate change is going to outperform over time. The technology has been changing. Alternative energy is a lot cheaper than it used to be. It's now cheaper than hydrocarbons without pricing and externalities that are starting to be priced in. Government policies are really starting to bite and have an impact. I believe that will increase significantly in the next few years. We can certainly hope the upcoming US election will be a signal change in that direction. And humans are starting to see the cost of climate change out their very windows on almost a daily basis, and that is changing their mindset towards how important it is we change how we are investing and our governments operate going forward. So just in terms of that technology, this is 2 years old, and the trends have continued a little bit further. One point I guess I didn't make at the beginning was that we'd be happy to make all these slides available to participants if you want to contact Galileo, as well as we can give you all the sources used to make these slides. You can see that coal costs for generating electricity from coal have really not changed over the last decade. Natural gas has gotten a little bit more efficient, but you can see that onshore wind and specifically utility scale solar power farms, panel farms, have really dropped in cost and are increasingly cheaper than producing any electricity from hydrocarbons. And so we are now moving into a world, we have moved into a world in the last few years where most of the investments in new electric generation projects are either in solar or in wind. And that starts, once you get the cost down, you start to see how that can really have an effect as we look at the parts of the world that generate and consume the largest amounts of electricity. These two slides of the European continent show on the left-hand side how much, where the sun effectively shines, where the photovoltaic output and potential lays, and as it's probably no surprise, it's down closer to the equator, so it's in Spain and in southern Italy, and it's not quite as sunny in Scotland and in Denmark. So of course that means that we have many more solar panel farms being installed in Spain than we do further north. And then on the right hand side in the darker map, that's the average wind speed and where it's economical to produce electricity from wind turbines in Europe. The darker reds and yellows are where there's a lot of wind, and where it's purple and green is where there's not very much wind. And so that's why if you travel to Denmark or northern Germany, you'll see so many wind turbines. The same goes in Ireland, where many panels or many wind turbines are being installed. Now, the ability to transfer electricity over large distances has been increasing as well. Norway has now dropped very large electric amperage lines underwater from Norway to feed the Danish grid, also another line to the Dutch grid, and another one to the German grid. And the Norwegians and the British are about to finish a line that runs from Norway to northern England. And once you can start to move electricity large distances, you start to have the ability to offset some of the intermittency of alternative power. So why are the Norwegians building these long distance lines? It's because they have a very large amount of hydropower up in their country, and they can export that energy. Increasingly, once you start to have intermittent solar or wind farm ability, you can start to run that electricity backwards back up to Norway when you have excess electricity to pump water from down below the reservoir back up to the reservoir. And then when electricity prices rise, you can run the turbines again. So you can start to use reservoirs as a battery to store power, in addition to using the more traditional lithium-ion battery technology. Also, of course, in Ireland, there's a great deal of wind if you visit Ireland in the winter time. However, in the spring, there's very little wind, but that happens to be when the sun starts to come out more in Spain. So it's certainly possible to envision lines that will transmit electricity underwater between Spain and Ireland, and potentially between Sicily and the northern industrial parts of Italy, etc. And we have similar possibilities in the United States. So if you take a look at the left chart, that's again, the solar potential parts of the United States. I live in California. Yes, it is quite sunny here. I do have solar panels on my roof and a Tesla Powerwall. You can see that a large percentage of the southwestern part of the quadrant of the United States, as well as Florida, could generate almost all the power it needs from solar. And if you add to that improved storage, both chemical as well as mechanical, you have a real opportunity there. Then if you take a look at the right-hand chart, that's where the wind is in the United States. And you can see in the northern part of Texas up through the Great Plains, a great deal of wind that can be used to feed the large urban and industrial areas in the Midwest and in Texas. And then along the East Coast, there is so much offshore wind along the East Coast that Stanford University researchers believe there's enough wind to power the entire eastern seaboard of the United States, and several offshore wind farms are now under development. And again, once you start to improve the technology to transfer electricity from one part of the country to another, you can offset the intermittency issues of many alternative power sources.
And James, are you also looking at a core temperature? Like for an example, in Finland, they're using temperature from Earth's core. They're pumping down like 12 or 13 kilometers under, like in Espoo, in the city they did it. They're generating heat, which can heat nearly 1/4 of the city. And the best advantage of using Earth's core is that it's demand driven, while in fact the wind and sun is supply driven, because there is a supply or there is no supply. But the Earth core, you just take out as much heat you want in the winter, and in the summer you can replenish that heat back by cooling the houses. Are you looking into also that sector?
Yeah, well, first of all, I will get to geothermal, which is a real opportunity in many places, and obviously does not have the intermittency problems. Where you have the ability, and there are places all around the world that are utilizing geothermal. Geothermal is basically an on-demand product. It's always there when you need it. Once you can bore the holes, set up the equipment, and know that the heat is there. And then, yes, there are many other storage capabilities that are out there. Siemens Gamesa is just an example, has basically a more advanced version of the good old sauna that they'd be very familiar with in Finland, where you take an old coal-fired plant, you fill it up with rocks, and you use electricity from alternative energy when wind or solar energy is plentiful. and prices are low, and you heat those rocks up to thousands of degrees Celsius, and then you use that heat later when you need the electricity and the sun's not shining to turn water to steam and turn a turbine and create electricity. So again, there are many, besides geothermal, which could be part of the answer, there are many sorts of ways to store energy out there, and we've only just begun to consider storage, which we can pair with intermittent green energy, which is again becoming increasingly cheaper than that of hydrocarbons.
Yep.
All right, so moving on again, so the alternative energy is becoming cheaper than hydrocarbons, and that of course is without the hydrocarbons being priced for their externalities of not just the negative impact on our climate, which could destroy our civilization, but also the pollution and the many deaths from pulmonary problems that come from burning coal, petroleum, etc. And governments have really started to increase the number of climate laws that they are enacting. They are starting to force the end of sales of internal combustion engines in many countries, either currently or in the next few years. And carbon pricing and cap and trade policies have really begun to increase. China, of course, as the second largest economy of the world, just rolled out their carbon pricing initiative. Those pricings at this point are not high enough. They are not driving industry away from hydrocarbon as quickly as they should, but as prices begin to rise, they will begin to bite, and hydrocarbons will become increasingly expensive to use to generate electricity moving forward versus alternative energy, which again, because of technology, has become cheaper than hydrocarbons without the externality pricing in place. So if you're going to be an investor, investing in hydrocarbons, of course, from time to time, the oil prices are going to go up and those stocks will outperform. However, over time, you have a lot of trends against you, and there are a lot of tailwinds helping out alternative energy moving forward. Finally, as I mentioned before, investors and individual voters are really starting to see how climate change is starting to bite. Even in the United States, even in so-called red states that voted for Donald Trump in the last election, more than 50% of Americans in those states now believe that climate change is real and it is man-made. And of course, as the US as a whole, it's well over 70% now. The younger the people in the United States, the more likely they are to believe in climate change. The closer they live to the coasts, the more likely they are to believe in climate change. And of course, one of the reasons why if you live near the coast, you believe it is because you're seeing higher level, more storms. You're seeing, if you live down south, you're seeing more heat, which leads to lower outdoor worker productivity. Unfortunately, it's quite well documented that higher levels of heat lead to humans engaging in more violence. And we're also seeing rising sea levels starting to interfere with water aquifers as they are invaded with salt. So this chart is from Brookings, and it shows where GDP at the county level in the United States will be negatively impacted by the end of this century by climate change. And you can see a great swath ranging from Western Texas all the way down to the southern tip of Florida, having up to 25% or more of their county's GDP being negatively impacted and reduced by climate change. You can see there's a little bit of positive if you look at the northern tier of the United States, where it's going to be cooler. I'm sorry, it is cooler, and you have harsh winters becoming more mild. You're going to get longer growing seasons. You're not going to have to spend as much money on indoor heating, and those areas might be somewhat possibly helped. And what comes out, of course, is if you look at the United States on this chart of the world, you can see that climate change is going to have a small negative net impact on GDP. For Europe, you can see it's mostly a wash, except up in Scandinavia, where it'll be a small positive. Of course, this really isn't fair, but the world's not necessarily fair. These are the parts of the world that have cumulatively pumped the most greenhouse gases into the planet's atmosphere, and they are potentially going to be impacted in a neutral manner or even slightly positive manner by climate change. And then you can take a look at the countries on this chart that are bright red. These are countries that could see up to 100% of their GDP reduced by climate change. And of course, that is extremely scary when you think about the billion people living in India.
Yeah. Can I add something to this, James? I think one of the issue with this graph is that people should not take it as an absolute truth. For example, when we speak about an average temperature change of 1.5 or 2%, we are not talking about a rise of temperature all over the world of 1.5 or 2 degrees. In fact, in some places like in Arctic, a friend of mine, he goes there every year, where temperature has never gone above 0, or today it's going to plus 25, plus 30. So, or in the Saharas, where it can fall down to minus 10, which is having a devastating effect on the local ecology and the environment. So we are not talking about just temperature change all over the world of 1.5 or 2 degrees. And secondly, this map, unfortunately, has also been misused. Like the Polish Minister of Environment, he uses this map and says that the economy of Poland, global warming and climate change is good because his country's economy will go up. But what they are not understanding is that this map is considering only one variable, that's the change of temperature. But on the other hand, the variables which are being caused by the change of climate change, like you mentioned yourself, the rise of sea level, the loss of biodiversity, and all these things, which are also going to cause havoc in both the northern and the southern hemisphere. And that is not visible in this map. So that's why I just try to warn the audience not to take this map as the absolute truth.
Absolutely, and of course, this map is just based on models which are put together from incomplete information. This again is a temperature change model. If we go back a slide to the Brookings model for the United States, this does take into account extreme precipitation events, larger storm surges, loss of drinking water due to salt invasion into aquifers. So it's a little bit more encompassing. But I think what my point here is that one, alternative energy is becoming much cheaper to produce, and it is now equivalent or cheaper than hydrocarbons in many parts of the world. Two, governments are starting to make hydrocarbons price in their externalities. We're nowhere near as far along as we need to be, but we are starting to move in that direction. And so hydrocarbon costs will only become more expensive. And three, citizens of the world are increasingly seeing climate change take place with their very own eyes. And they are seeing it in storms hitting the United States and fires in California. They're seeing it in typhoons hitting parts of Asia. And it is starting to lead to them to urge their climate ministers and politicians in places as far apart as Canada to Poland to react and change their policies to take into account climate change, take into account greenhouse gas emissions, and hopefully lead to ever more rules against burning hydrocarbons and force hydrocarbons to be priced for their externalities. And again, as this takes place, the impact on the stock market will be the cost of capital for alternative energy and storage will go down, and the stocks will outperform. And those in the hydrocarbon space will find that their ability to raise capital will become ever more dear, and their ability to obtain even basic business services such as insurance or maybe even steel going forward will become increasingly constrained by companies unwilling to supply them with basic business operations because their own investors, their own customers, their own employees have churned against using hydrocarbons. So now that hopefully I've laid out the basic trends that are driving this, I think investors need to think a bit about how quickly they're going to shift their portfolios. The concept here, of course, is one, to invest for positive change in the world, but if you're going to lose a great deal of your money, that's not going to help. And for professional investors, if you underperform, you're going to have your assets taken away from you. You'll be fired, and they'll give the assets to someone who is investing without thinking about alternative energy. So moving too quickly could be a negative. Obviously, we think that moving, and I believe, and I have invested this way in my personal assets, that you want to shift your assets and your investments away from brown industry holdings. You want to buy more green stocks, and you want to consider owning stocks in sectors that are better poised to benefit from mitigation spending for climate change. So on this chart, there are no numbers, but just if we think about this holistically, in the bottom left corner, if we're going to have a base portfolio and we're going to move it up and to the right to a portfolio that is invested for as an impact portfolio, away from hydrocarbons towards companies that are going to benefit from mitigation and adaptation for climate change, the faster the societal change is taking place, that you perceive it taking place and you see it taking place in the stock market, the faster you want to migrate your portfolio up to the impact portfolio. If, unfortunately, it's moving at a slower pace, it doesn't mean you shouldn't be moving your portfolio, but maybe you should consider moving at a somewhat slower speed. Personally, I do not own any hydrocarbon stocks anymore, and I've simply divested. I am short some, I've bet against some companies in the space that are very carbon intensive. That's perhaps a more quick movement that many investors are going to be willing to take, but hopefully this presentation will help you have some confidence and some ideas as to how you can start taking those first steps. So let's move on to some individual sectors that are poised to win or poised to lose as climate change increasingly is affecting the capital markets. And we'll start with the hydrocarbon industry, which is the one that comes to mind to most. And there are some tailwinds, unfortunately. As Ben mentioned, in India and China, they're still industrializing quickly and increasing the amount of hydrocarbons they use. The path of support for green policies has not been and likely will not continue to be perfectly straightforward. We can hope for 2 or maybe 3 steps forward, but there are going to be some steps back. Certainly, the election of Donald Trump in the United States was a step back with his drill baby drill mantra and complaining that wind turbines kill birds and the sound causes cancer, which doesn't seem to make too much sense. And in France, of course, when the government tried to raise fuel prices, many people in rural areas donned the yellow vest from the boot of their car and started protesting. So, you know, clearly we are not completely on the same page, but we have been moving that direction. Now, thinking about the headwinds to the hydrocarbon industry, they are significantly greater in scope. Again, as we mentioned, there's more taxation on externalities of energy. The standard gas-fired cars are being phased out in many countries. As I mentioned, the cost of generating alternative energy has been falling quickly. Consumers are increasingly choosing greener products, be that from a car to even the carbon neutral beer. And again, many of the hydrocarbon companies are starting to find that they can't get some of the basic supplies that they need from the capital markets that they depend upon. So if we take a look at this slide, it's from 2017, so a couple of things have changed, but the general trend for most of these companies is still the same. It ranks the carbon intensity of each of these international oil majors. And you can see we've mentioned Suncor already being the most carbon intensive of all the major companies in this space, running down through Repsol, Encana, and Gazprom, which are much more natural gas focused, which has a lower carbon intensity. So I would suggest that if you're not going to be willing to take the step to simply sell everything in the hydrocarbon space in your portfolios at this point, at least you want to consider shifting from the left-hand side of this chart to the right-hand side of this chart, simply because you will lose less money going forward because the companies on the right-hand side will be less impacted by carbon cap and trade rules or carbon emission taxation, and the companies on the right-hand side of the chart will likely encounter less opposition from investors going forward as those on the left-hand side.
Can I add to this that you can take 2 very big investors in criteria here. One is the Rockefellers, and one is, for example, the Saudi government sovereign fund. both of them are moving. Rockefellers have already completely disinvested from the petroleum and fossil fuel, and the Saudis are also moving away. And both of them created their wealth in the very first place from petroleum. So they seem to know something that apparently we don't know yet.
And I couldn't agree more. Again, this goes back to a concept of fairness. Is it really fair that the Norwegians have become a very wealthy country from finding and sending hydrocarbons to the rest of the world to burn? And now they are primarily dependent for their energy on alternative green sources of energy, and lecture the rest of the world that they shouldn't be using hydrocarbons.
Exactly.
And of course, the Saudis, we know about the Saudis. So again, the capital markets have absolutely nothing to do with fairness. And if you're trying to invest to make money in the capital markets, you have to, at the end of the day, look at the bottom line and making money. What I'm arguing here is that for better or worse, if you're investing in Suncor or Petrobras or Canadian National or Marathon Oil, those company stocks are at risk moving forward from many types of disruption to their business model. And those on the right-hand side of this chart that focus more on natural gas, as natural gas potentially being a bridge fuel between petroleum and alternative energy, perhaps have in a better position. Now, we talked about how Shell and British Petroleum, or BP, they've been using their excess profits to invest in wind turbines, to invest in solar panels, to invest in electric car charging stations. They are effectively trying to move from being buggy whip manufacturers to being automobile makers, or moving from being companies that make pagers to becoming cell phone companies. The problem is disrupting your own business model is very difficult, and it's generally much easier and much more successful to invest in the disruptors in the industry rather than the legacy companies trying to completely retool their business model because they have too many legacy impediments in place to successfully make that jump. So if we could take a look at some of those companies that are involved that you can invest in, these are billion-dollar companies. In many cases now they have histories of profitability. These companies are becoming green ships. There are real and profitable companies you can invest in this space. They are not fly-by-night companies anymore. So if we just look at some alternative energy operators, we're not going to go into too much detail on individual companies today. We don't have time. We will do that at the next webinar where we try and do a deeper dive into individual companies and sectors in the energy space. But Ørsted out of Denmark is the largest company in the world in terms of installing and managing wind turbine farms, both onshore and offshore. Brookfield, it's a Bermuda-based company. It's really a Canadian company, but they have focused on solar, but even more on hydro around the world, particularly in North America. And again, hydro, not only is it green power that is dispatchable upon demand rather than intermittent, but perhaps all those huge reservoirs are increasingly going to be even more profitable because they can be used as batteries to pump water back up to the reservoirs behind the dams and behind the turbines moving forward. Azure Power is a company installing solar panel farms and rooftop solar across India. This is a company that does not yet make money because all their profits are being plowed into investing in new projects in India. The demand for electricity in India is massive. Azure is the best way to organically play that in the stock market right now. And then Ormat is really the only pure play out there for investing in geothermal. They make the products for geothermal. They drill the bore shafts to find the heat deep in the earth. They build the turbines, and they manage the generation plants after they're built in many places, or they turnkey and sell them off to other countries and companies around the world. Moving on to some equipment makers. Again, this is very much a space where there are large companies that make real profits and are accepted in the capital markets now. Vestas is out of Denmark, is the largest manufacturer of wind turbine products in the world at this point. It's got the largest market share outside of in the world. And its market share has been growing, particularly outside of China, which China is a bit of its own story due to the government's mercantilist policies in wind, solar, and battery storage and electric automobiles. TPI is a US company that makes the blades for wind turbines and sells to most of the major non-Chinese companies. Siemens Gamesa, the merger of the Siemens wind business and Gamesa out of Spain, also a large and profitable player. Moving on to solar, you've got First Solar in the United States that produces PV products that have some IP involved and some moats around their business, potentially a bit more, it's a bit more expensive, but potentially is better insulated from some of the harsh pricing that takes place in the solar space that leads to low profits. That is primarily because you've got companies like Jinko out of China, or Canadian Solar, which is a Canadian company, but primarily manufactures and sells out of China. Solar Edge, one last company I'll mention right here, is an Israeli company that makes the inverters inside the solar panels to convert the direct current from the solar panels into the alternating AC current that's needed to supply the grids and our homes. Moving on from mitigation to adaptation, I would also talk about how infrastructure companies are very well positioned to make money for you in your portfolios going forward. I would focus not on Europe here, but on the US. And why on the US? Unfortunately, in the United States, we have massively underinvested in our infrastructure over the last few decades. It's much easier to replace a road, a bridge, a dam, an electrical system that is falling apart than scrapping one that is brand new. If you've just built a new road in Germany and you've got too many storms that are flooding that road and putting it out of service for more days each year, it's difficult to tear it down or to raise the roadbed if you've just finished it, versus in the United States, if you have the same sort of problem with a road, but it's falling apart and has been on the list to be replaced for 20 years, it's a little easier to spend that money on the adaptation and elevating that roadbed, rebuilding that dam, or upgrading the electrical grid. The US dollar remains the reserve currency. Bond yields are extremely low, so the ability to raise money for infrastructure projects are quite high now. And of course, we potentially on the verge of a major political change in the United States, where one administration would be leaving that has not believed in global warming and has not been able to prioritize infrastructure, for a new administration that is promoting a Green New Deal and significant climate hardening of a lot of our infrastructure. And then finally, as you can see on this chart, the US savings rate has actually been rising since the mid-2005, so more than 15 years. It has really spiked, of course, because of the COVID pandemic, but it has significantly gone up. So there's a lot of capital in here in the United States looking for some sort of yield, and some of that yield could be in infrastructure spending. And once you start to get above 10% savings rates, you're starting to talk about Swiss or German savings rates here in the United States, which is significantly different than the mindset many investors have about US savings rates. Here in the United States, you can see that because we have starved infrastructure for spending here on the left-hand chart, the amount of capital going to infrastructure has continued to go down, while the operation and maintenance to just maintain and run old projects continues to rise and eat up more and more of what funding there is in that space. And then on the right-hand side here, you can see, and this was for the next, from the 10 years of the decade from 2016 to 2025, we're halfway through it, you can see more than $1 trillion of unfunded infrastructure needs in the United States. And this does not even take into account any climate change, any impact of greater storm surges, any impact of greater forest fires, any impact of more flooding going forward as climate change, unfortunately, increasingly bites in our society. So thinking about some of these companies you can invest in, the easiest way or the most profitable way is likely in the engineering construction management companies. I'll start with a European one. Arcadis out of the Netherlands is a specialist in water management, and many more port cities in the developed world are going to need storm surge barriers. These are huge projects. Arcadis is one of the few companies that's an expert in doing them. Jacobs, ticker is just J in the US, is part of the S&P 500, the largest company in this space. And again, I would focus your attention on US companies for infrastructure spending. And then finally, I'll highlight WSP, which is a Canadian company with operations in Europe and the United States outside of Canada, as well as Canada, in this space. These companies, since they don't actually manufacture the concrete, the gravel, the steel, their greenhouse gas emissions are quite small. They're basically management companies. When countries want to engage in very large infrastructure projects, they need to hire these guys. Their revenues can go up significantly, and a great portion of the revenue growth can fall to the bottom line and help the stocks. Concrete and roads, Lafarge is the largest company in the world in this space outside of China, based in Switzerland. Vulcan or Martin Marietta are well positioned in the United States. They make the boring aggregate or gravel that you use to engineer a roadbed and the asphalt that you put on top of it to finish the road. If you're going to overinvest in infrastructure, what you underinvest in, I would suggest you may want to consider reducing positions in the defense space. That's not because global warming is going to lead to less war or less violence or fewer refugees. Unfortunately, it's going to be the exact opposite. However, the defense stocks that we invest in, we think about in the developed markets, generally sell very expensive weapons to a small number of countries in the temperate regions of the world, and you really don't need an F-22 or a large aircraft carrier to deal with a potential of refugees. That's not really going to help that situation at all. So those companies, particularly in the defense space that are focused on aerospace, may be in a bit of a bind going forward as they see their revenues go down as more money has to be spent on infrastructure out of government spending. And of course, as we can see on this slide, COVID has made the deficits in the developed world much worse very quickly. And so something's going to have to give. And I would argue it's probably going to be in defense spending. You don't want to be there. So, you know, most of these companies are relatively well known. I also think you want to consider what's going on in the auto and auto parts space. Electrification of the auto space is a real problem for many of these traditional companies. Infotainment and the autonomous driving cars are also part of the problem, meaning that we have wrenching changing here. But we definitely have disruptors such as Tesla or NIO and others that are seeing their cost of capital go down as their stocks surge. Incumbents such as Volkswagen or Toyota have really tried to change what they're doing and move towards electronification. It's not clear who's going to be the winner and the loser in terms of the incumbents. I don't know exactly who are going to win and who are going to lose, but I can say that the engine makers, such as Continental in Europe or Cummins in the US, they've got a very tough road ahead of themselves. And the parts companies here in the US, which have well over $50 billion in market cap, O'Reilly, you may or may not have heard of, or AutoZone, have real problems going forward. Not right now because everybody needs a car in the United States and no one wants to engage in public transportation. But going forward, electric cars don't need a lot of the parts these companies sell. And there's real overhead problems and top line problems for these companies going forward. So just to summarize, there are a lot of trends out there that are pushing the markets away from the brown industries and towards the green ones. I believe that an impact investment portfolio, it has started to outperform as of late. If the election in the United States goes the way I hope it does in November, that could really spur that change to move going forward. I believe that investors should, if they have not begun transitioning their portfolios towards a greener portfolio, they should be considering how and when they're going to be doing that and how quickly. There are sectors that are very well positioned for this change, and there's some that are very poorly positioned, and investors should be cognizant of it. It may become the primary driver of the stock markets in the next 10 or 20 years. And again, hopefully today's presentation, it's only the beginning, it's only a starting point. There's a lot more work to be done. So with that, I'll turn it back to you, Ben, and to Gabrielle.
Hey, thank you, James. It was amazing. I mean, I learned so much in your presentation today. I had a couple of questions I wrote down, and then I'll go over to the questions from everybody else. First is that your presentation is extremely factual based. I mean, it's really, it summarizes and says everything that is how it is. But what do you think, in your opinion, is the reason that still there is so little investment in the impact investment sector? If you look in the compared to the total AUM, I think it's something like still 0.68 or 0.7%. Do you have some idea why it is still so low interest? Is it because it's new or what?
I think that the reason why there is not as much invested in the green space as there should be, or one would imagine there would be, with the large number of facts that we can look at and the actual performance of stocks in the market and underperformance of stocks in the market today, is twofold. One, as you said, it's fear, it's new, and despite what you may read about in terms of institutional investors being people who are trying to think and find the next best and big thing, they are generally reticent to change. Change scares large pension investors, and it's a bit of the tall poppy syndrome. If you're the poppy sticking up, you're the one that's going to be cut potentially. And so there is concern about taking too much risk. If you take too much risk and you lose some money, you'll be in significant trouble. The other problem is that if you take a look through 2000, 2010 at investing in the alternative energy space, it did extremely poorly. It was a great place to lose money in a noble cause. And that has scared off many people who did invest in that area, that they only lost money for what little toe they stuck in the water there, and they've shied away from it afterwards. Certainly now we see in the last couple of years, significant outperformance from the green energy space. And that's not just from companies such as Tesla that have really taken up a lot of headlines, but just boring companies like, many would call them boring companies that just run, such as Atlantica Yield or Brookfield, that run water turbines and reservoirs. They've really outperformed over time as investors are increasingly starting to believe that hydrocarbons really will be priced for their externalities, and companies that are involved in alternative energy production are going to be able to raise their prices against that and see their profits rise. I believe the long-term growth prospects now for many alternative energy companies, many companies in the adaptation space and infrastructure, the long-term growth there will be significantly higher than that of companies in these brown industries or other industries I mentioned that are going to be negatively impacted going forward.
Okay. Before I move over to the questions asked by the people listening to this, I had another. Do you have any impact investment funds, or would you mention some names which are good for retail investors?
There are several ESG funds that are out there. Of course, ESG is defined differently and by different people, and it includes many more things than just green investing. But obviously, they have been growing, and in general, if you're relatively early in a trend that continues to build, you will make money. That's how it tends to work. In the markets, you want to be early as long as you're not too early. Grantham, Jeremy Grantham has pledged that he's going to donate his entire fortune of $1 billion towards green initiatives, and his firm has a mutual fund that invests in this space. it has not done all that well as of late. It's been overinvested in copper, expecting a large infrastructure rebuild in the electric utility area. There are individual ETFs here in the United States, such as TAN, T-A-N, easy to remember ticker, that invests in the solar space. And many of them have done quite well as of late. So there are individual funds in which you can invest, as well as picking individual stocks.
Okay, thank you. And one of the questions asked by from Alex is, what about investing in energy storage?
All right, so in terms of energy storage, the question will be, first of all, what sort of medium are we going to use? The primary medium for energy storage right now is lithium-ion batteries. There are several mining companies in the lithium space in which you can invest. Lithium has been in a position of oversupply for the last few years. That's because too much capital went into expecting a big growth in lithium-ion battery demand. And then, of course, COVID has slowed down GDP output around the world. So it's potentially a very good time to invest in companies like Albemarle or Livent that mine for lithium and refine it into products that can be used for batteries. There are potentially other lithium-based products different than the ones we use today that will become increasingly more cost-effective. There is the risk that potassium-based batteries will supplant lithium, which is a risk for lithium investing. So I would not recommend considering putting too much into that one basket. And then, of course, we have other types of storage. I've mentioned reservoirs, which I believe could make companies in the hydro space significantly more valuable going forward than they are today in terms of stock market investing and owning those stocks. There's trapping heat, as I mentioned, Siemens Gamesa's product. There's also other forms of mechanical storage, such as basically as simple as you lift up some big pillars of concrete with a crane and with electricity when it's cheap, and then you lower it when you need the electricity when it's more expensive, and you use that to drive the turbine. There are many different products. None of them are public at this time, so that's more a VC sort of investing, but I believe we will see more mechanical storage options in the stock market in the near future.
And a question on a personal note, somebody asked, what motivated you to write the book, Hot Stocks, Investing for Impact and Profit in a Warming World?
In terms of why care about alternative investing and green investing and why write the book, it's mostly because the analysis I've been doing, the research I've been doing has been telling me that we are moving towards a capital market that's going to be driven by climate change. I live here in Northern California, and believe me, I see the climate change every day right now, between the fact that it hit 100 degrees in San Francisco the other day, which is just unheard of. Our forest fires get worse and worse each year and cause a significant drop in GDP because the air quality is so bad. People are seeing it in other parts of the United States, along the Gulf Coast, where hurricanes keep getting worse and flooding keeps getting worse and worse in places like Miami every year. It's starting to impact people in Europe as well, and certainly in countries closer to the equator in addition to that. So I believe that the information flow tells us that climate change is going to become much more important to the capital markets. And I believe that for my own investing, I needed to know more about it. And the more research I did, the more I realized there was a real hole out there, that there are, as you asked about, are there any products in which you can invest for green investing? There are, but they're quite diverse. There was nothing out there that was a simple handbook for individual investors, high net worth individuals, or even institutional investors who had not thought about shifting from brown to green portfolios, to be able to start and have the beginning of a roadmap to migrate their portfolios to outperform in this unfortunately scarier world in which we're increasingly living. So that is really what led me to want to write the book. Is one, there was the opportunity that there was no guide out there. I do think people will be able to outperform if they invest for a green portfolio going forward. And finally, if we do make more money investing in green portfolios, it will increasingly bring to an end the age of oil, which will not end for a lack of oil. The Bronze Age did not end for lack of bronze. It ended because we came up with better technology. And oil as an age will not end for lack of oil. It will end because we've come up with better technology.
And a personal question from my side, where can I get your book? Is it available on Amazon or?
Yes, Hot Stocks is investing at a large monopolistic marketplace near you. Amazon has it, Barnes & Noble has it. You can buy the Kindle version, the electronic version, you can buy the hard copy version. Hopefully the price point is low enough that for investors who are going to be investing significant sums of their net worth, it's a very small cost, and hopefully it is will be somewhat helpful to returns for investors going forward.
Then I go back to the audience and somebody asks, how do you select or identify stocks? How do you suggest we evaluate the impact? And are the companies reporting impact measurement?
All right, so just in terms of companies reporting impact measurement, increasingly larger brown industry companies are being forced to report their impact, their greenhouse gas emissions. Many of them on their websites under the investors tab will have a sustainability report. They will tell you, and this ranges everything from a company like Total down to concrete companies here in the United States. They will tell you how much they are emitting each year and what they are doing to reduce those emissions, how much those emissions have been reduced, and what is their current goal. And if you believe that current goal is going to be enough to help those companies generate additional profits going forward and have their stocks outperform companies that are not focused on sustainability, then I think those are very good investments to consider going forward. In terms of after you put on that green versus brown overlay, I think in terms of stock selection, are you a value investor? Are you a GARP investor? Are you a long-term growth investor? Are you a momentum investor? I don't believe that any of those major investing paradigms are inconsistent with using an alternative energy and climate change overlay to the portfolio analysis and individual stock selection analysis.
One more very interesting question I found is, how do you identify impact ventures that are not popular, which are not known to everybody? How do you find them?
Well, first of all, so I think if those that are not popular, many of them are not yet public companies. I have spent my career in the public investing space. I ran mutual funds and then hedge funds for a couple of decades. So I don't spend much time looking at new companies that are not yet public that are startups. There are many areas, many companies in the venture capital area and the private equity area that do look at these newer ventures. And I would, if you don't want to invest in the public markets and you want to invest in the pre-public market, I'd highly suggest that investors with significant sums of money start to ask PE firms or VC firms they've been considering which ones and how they are considering green investing. In terms of how you find some of those companies, hopefully my book has scores of individual names in the space, many of which like an Orbat, which is the best pure play for geothermal energy, is probably a name that most individual investors have not heard of, and hopefully the book would help give one some ideas. Another would be, for better or worse, take a look at the holdings of ETFs of countries that are better positioned for climate change. Could be Norway, could be New Zealand, and I think you'll find some companies in those holdings that seem better positioned for climate change and for helping to mitigate or adapt to it than for better or worse, those in some of the less developed markets closer to the equator.
Okay. And do you think we need a platform, a trading platform or something that focuses on renewables?
No, I don't really think there's a need for a specific trading platform. There are so many excellent trading platforms for individual investors to use now. In many countries, commission costs have become exceedingly low or even have gone to zero. So your ability to invest completely in a green portfolio in a more mainline trading platform is quite achievable now. And for institutional investors, they already have, of course, all the significant firepower trading ability that they need. What we really need them to do now is pick up a copy of my book, join or consider joining Climate Action 100 Plus, and start to consider not only is green investing the right thing to do, but if you ignore it, will you lose your job in the near future due to underperformance? And I believe fear is one of the best drivers of movement in this space, particularly among institutional investors.
I agree. And with this, I just want to add the last question. This is asked by Svetlana, who is the CEO of Galileo. She asked, do you think that in this way, like you're mentioning in the world of by impact investment, can we avert climate change, or do we need some kind of mass destruction before public or people finally wake up and the governments wake up?
Investing with a green mindset in the stock market will hopefully lead to outperformance. Hopefully it will slow climate change. It will not stop it. Hopefully it will lead to entrepreneurs and investors trying to come up with carbon capture and sequestration technologies, which could end climate change or even reverse it. That technology has not yet been developed. I don't know where it's going to come from. I hope it's near, but greed, of course, will drive investors. Investors want to, and inventors want to invent something that is going to be very profitable, make them famous, and if it changes the world and makes it a better place, all the better. So hopefully those technologies, if investors and inventors take a look at the share price action of companies like Tesla or Plug Power over time, that will incent them. In terms of, do we need a massive, immediate crisis? I hope we don't have to get there and see a real negative impact on a large part of human civilization to wake humans up to the fact that we need to change our ways. Hopefully it is something that can be evolutionary, hopefully a quick evolution, not a slow one, but one where the capital markets can be part of the solution rather than what they have been, which is part of the problem. And hopefully investors, not only can we be part of the solution, a very small part of the solution, and it doesn't just mean buying an electric vehicle or recycling your trash and sorting it, but hopefully by actually the way you invest will not only help alleviate climate change and the crisis to civilization, but also it would have the added benefit of leading to higher returns and higher profits for investors who engage in a green overlay in their investing.
Thank you very, very much. It has been the most learning for me too. And I go to a lot of events, really, it was perfect. Thank you. Now I pass it over now to Gabriela. Gabriela, are you here? Yeah.
Yes, I'm here. Thank you so much, both. It was a really, really interesting session for all of us. Thank you also for taking immediately all the questions from the audience. And yeah, this is for everybody what Galileo is promoting. It's doing work in expanding basically or spreading the word about what impact investing is about for everyone, for private persons, for institutions, for associations, for profit, non-profit. I think this was a great example, especially I really enjoyed the discussion, and I was also like really attentive and learning a lot. So thank you both for everything. About Galileo, yes, again, we are an association that was founded in 2018. We are an official registered association in Zug, and this is the type of work that we're doing. We believe that impact investing does have the potential to achieve this social and environmental change that we are all dreaming of, and therefore we invite you all to join us in this mission. And we are offering to the community memberships. Any of you could register and become an official member of the associations. We have individual packages, and we also have packages for corporates and for organizations. And depending on what you choose, you're very welcome to join us. And this way you could also attend many webinars that we organize, but also our partner organizations. More about us you can find in our website. And I would also like to share with you some good news for you tonight. We are offering for you a 30% discount for any registration that you may start before September 15th. For the individuals, there is a link. You will receive an email after this webinar tomorrow with the recording, with the presentation, and also with the link to get the 30% discount for the membership. And if you want to register your organization, just drop us an email to info@iic.ch, and we will be very happy to process your registration. And last but not least, we are inviting you all again. We will be very, very honored again to have James Ellman on board for a next webinar, where we will be deep diving with him into the energy sector transformation in an era of climate change. So please stay tuned. Same channel, and we look forward to having you all on November the 5th, the latest. Thank you both from Galileo, from all the team who has been behind us, the founders and supporters and volunteers. It's me tonight, the face in front of you in the name of Galileo, but there is a huge team behind us supporting us, and with professionals and experts like James and Ben. We are really positive that we can accelerate impact investing into becoming the new normal. Everyone should know about it and should have the option, and that's what we are doing. Thank you all for joining us tonight, and we look forward to seeing you very soon. Bye-bye.
Bye. Thank you.